What if I told you that 1% could cost you hundreds of thousands, maybe even millions of dollars over your lifetime? Not a market crash. Not a bad stock pick. Just 1%. Most investors barely notice it. It sounds harmless, even reasonable. But by the end of this video, you'll understand why 1% is one of the most expensive mistakes investors make and how to protect yourself from it, whether you're just starting out or you've been investing for decades. Why this matters to everyone. This isn't just a beginner problem. Professionals fall into this trap. High net worth investors fall into this trap. Even financially savvy people fall into this trap. Because 1% doesn't feel like a cost. It feels like a rounding error. But investing is a long-term game, and small numbers behave very differently over long periods of time. Let's break it down. What 1% actually means. When we talk about 1%, we're usually talking about fees. That could be a financial advisor charging 1% per year, mutual fund expense ratios, management fees inside retirement accounts, or layered fees you don't even see clearly. And here's the key. That 1% isn't paid once. It's paid every single year. Not just on your contributions, but on your entire portfolio balance forever. Let's look at a simple scenario. You invest. $10,000 per year. For 30 years. And earn an average 7% annual return. No fees. You end up with roughly $1 million. Now let's subtract 1% in fees, so your return becomes 6% instead of 7%. Same contributions. Same discipline. Same time horizon. Final result. About $760,000. That's a difference of $240,000. And remember, you didn't lose money. You just never got it. Why the damage accelerates over time. Here's the part most people miss. The damage from fees isn't linear. It's exponential. In the early years, the difference feels tiny. After 5 years, you barely notice it. After 10 years, it's annoying. After 20 years, it's painful. After 30 or 40 years, it's devastating. Why? because fees reduce the amount of money that gets to compound. And compounding is the most powerful force in investing. You're not just losing 1%. You're losing decades of growth on that 1%. Real-world perspective. Now imagine you retire at 65. You live another 25 or 30 years. Your portfolio needs to last your entire retirement. That missing $240,000? That's years of living expenses. Healthcare costs. Freedom and flexibility. Or money you could pass on to family. Fees don't just affect your portfolio. They affect your life choices. But isn't 1% worth it? Now, to be fair, not all fees are bad. If someone helps you avoid panic selling, keeps you disciplined, builds a solid tax-efficient plan, and adds real value, that might be worth paying for. But here's the critical question. Are you getting more than 1% of value every single year? Most investors never actually stop to ask that. How to protect yourself. Here's how smart investors minimize the damage. 1. Know your true all-in fees. Look beyond the headline number. 2. Favor low-cost index funds when possible. Costs matter more than most people realize. 3. Avoid unnecessary complexity. Complexity often hides fees. 4. If you use an advisor, demand transparency and value. You should understand exactly what you're paying and why. Remember, you can't control the market. You can control costs. Final takeaway. A single percent doesn't look dangerous. But over a lifetime, it can quietly steal a massive portion of your wealth. The good news? Once you understand this, you can't unsee it. And that awareness alone can be worth far more than 1%. If you found this helpful, consider sharing it with someone who's investing for their future, because this is one of those lessons that pays off for decades.